Welcome to Climate Finance and the Carbon Markets from Hong Kong University of Science and Technology. I'm Charles Bedford, professor here at the university, teaching this class this semester, and also doing a podcast out to the broader universe. Today, we've got Rene Velasquez, who is from CBL Markets, and which is one of the premier, if not the premier, carbon exchanges and on the planet in the voluntary market. Really, the leader, industry leader, and he's a principal and part founder and head of global carbon for the group. So we're really excited to have you here today. Thank you, Rene.
Thanks, Charles. Really appreciate the intro. That's great. Just to clarify, I'm not technically a founder, but I am an early employee, let's just say, right, in the startup's history. But I don't want to steal the thunder of our founders.
Well, I know you've been a huge driver behind the growth and the story. So why don't we start with that? So tell us, what is CBL? What's the background, a little bit of CBL, and then we'll sort of plumb a little bit of that.
Yeah, sure thing. Great. So would it also be beneficial to kind of give the class a little bit of background about my journey and how I arrived at this position?
Much better. Yeah, let's do it through through your journey and sort of your background, because it also it's sort of intertwined. Let's do it. Let's start that way, and then we'll move into CBL. Thank you. Yeah,
cool. No, the reason I mentioned that is because I think it mirrors the kind of evolution of the marketplace. So I joined carbon markets. Let's just say began my career in this space of all times, 2008, right ahead of really the beginning of the financial crisis, and I joined not only at that interesting time and juncture in terms of the evolution of the markets, but also as the market was effectively finding its identity, right? So preceding that time, and I guess you intimated this in your previous slides, the market around carbon in general had focused on compliance systems, in particular, also, or based on, I should say more accurately, on the Kyoto Protocol architecture, right? So the Clean Development Mechanism, CDM, was the dominant game in town. There was the ability to utilize some of those Kyoto units in the European emissions trading system, and there was effectively this ramp up of activity in the years preceding. So I came into a very vibrant market where the voluntary context was really the little brother of the bigger compliance market space, and CDM was the name of the game. Then the financial crisis hit, and it's fair to say that destroyed demand effectively. The market was not resilient enough. We also saw changes with regards to the structures around compliance systems, and effectively over the years that ensued, the CDM lost a lot of that momentum. It lost that inclusivity into compliance systems, and then needed to effectively find a home, and the only home available was voluntary markets. And so for a period of or a number of years between 2008 and let's say 13, 14, there was this kind of convergence of supply from purely voluntary, let's say VCS gold standard projects, and also CDM. And that effectively created an oversupply and effectively depressed prices for quite some time. Mind you, in the background, the demand side was effectively muted because of external risk shocks as a result of the financial markets. So that's kind of the context. When I joined a company called Climate Friendly, based out of Sydney in Australia. And they're essentially the incumbent at the time, what we would call today as an intermediary. And the intermediaries effectively provide a one-stop shop for corporate buyers to access the carbon markets. They not only can effectively aggregate and source carbon offset projects on behalf of their corporate clients, they typically also provide advisory services in the form of building, constructing, and recommending portfolios of diversified nature for their corporate clients. And sometimes they even go further upstream. They might do some carbon footprinting or life cycle assessments, et cetera. And it's really an end-to-end solution. Interestingly, that model is based on effectively opacity, right? Like they act as the conduit, or let's call it the agent for that corporate to the market. And they say, don't worry, we'll take care of this. That model obviously allows for arbitrage. And so typically as they aggregate this volume and this portfolio for the corporate client doesn't know necessarily what is the wholesale market price, but they get given this retail sticker price, and therein lies the arbitrage opportunity. And there are many other intermediaries that followed that model over the course of the years as the market was effectively fairly small. There was that arbitrage opportunity was warranted, and effectively the advisory services, the consulting that came in that bundle was never priced. It was always you made money off the transactions of the carbon piece. So I worked at Climate Friendly for an interesting time. They had just sold an equity stake to Macquarie, a big investment bank in Australia. So they were capitalized, they were growing, and essentially they needed folks with a kind of hybrid sales background, some climate finance experience or academic experience in my case, and effectively passion. So I came in very, very green, worked in that space, learned a lot. And then effectively I joined another company called First Climate in the same vein, an intermediary, but this case, a global player based out of Germany, headquartered in Frankfurt, and effectively I then led their expansion in Australia and really kind of learned my trade, let's just say, in country. I then relocated to New York in 2012 and effectively piggyback on my wife's good fortune. She was relocated to New York for work and convinced the team at First Climate that it would be a good idea for me to go across to the US and effectively set up shop for them there. They indulged me and I worked there for a number of years for them, effectively building out their presence and servicing US corporate clients. And it was a great time because I effectively learned a lot on the job, effectively doing what I mentioned. Structuring portfolios, providing some advisory service, and then effectively providing some custodial solutions to corporate clients where we would effectively help to structure those deals, buy those credits for them, warehouse them, and then retire them on their behalf. So end to end. And the corporates effectively paid an invoice. They got the benefit of claiming the emission reductions against their corporate footprint. Then in late 2014, fortuitous event, I met up with the founders of CBL in New York. They had just opened up an office there, and obviously this market is fairly small. We all know each other, and I'd lived in Sydney for many years, so I would follow their progress for many years. And essentially, over a drinks session, was asked very bluntly by one of the founders, Ben Stewart. He said, in his classic kind of Australian, he said, "Mate, what have we got to do to get you to come across?" Which I felt was very, very, very nice and quite humbling. And effectively, we figured out a way to work together. And so that was the kind of the journey, entrance point into this journey that I've engaged on since then, like 7-8 years, right?
Let me just to kind of like drill down a little bit on that. So really the 2008 to 2014 period was characterized by this kind of boom and then bust and kind of the consolidation. But by the time, and then in the space that you were working in was fairly, there weren't that many people who were actually doing this kind of intermediary service, essentially providing essentially services to the corporates who wanted to understand the market and understand the projects, and services to the projects who are really much better at doing work on the ground than they are at selling into the corporate market. And so that space, but there couldn't have been that many of you out there, given the kind of the size of the carbon market at the time.
Yeah, absolutely. You nailed it. It was a tiny little boutique market and one that suffered from attrition, right? There was a whole lot of expertise built from 97 through, 2008, I would say, and even 2010. And folks that were finance background, commodity traders and consulting, advisory, banking, finance, who then, joined the carbon markets thinking that there would be this asymptotic growth. It didn't occur. Sorry, exponential growth, and it was asymptotic. It actually beat it out, and then it fell off a cliff. And I remained right. I was just one of the diehard converts, and yeah, it's a small community. So the community is effectively all the ICROA members, right? ICROA is the International Carbon Reduction Offset Alliance, and it's essentially the grouping of all the intermediaries and advisory firms in this space. And yeah, effectively each one had their own kind of patch and would service clients and essentially trade in that space. But it was very communal and we all collaborated, but it was also very competitive because the market was so small, right? But that was the lay of the land. And so in 2015, when I was presented with this opportunity, I took it with and I grabbed it with both hands. Essentially, I saw an opportunity looking into my crystal ball, thinking, hey, carbon neutral commitments will continue to grow, right? I foresaw the demand potential just because of the climate crisis, that there was an inevitability in this market, right? And I saw that if this market continued to grow as I thought it would, and thankfully have been proven, validated, that the market would need to evolve its very nature. It could no longer remain an opaque market driven by purely bilateral trading of, hey, I'm a nice consultant guy, come and do a trade with me. Like that's not scaled.
That's a really important point that I want to make sure you sort of pull that out. I mean, this was a market that was very much word of mouth, handshake deals, no sort of price transparency, no information,
none
movement, none. Essentially, it was fairly small, and so that worked
fairly small.
But the notion really behind an exchange is to get beyond that, essentially the market square where you bring your vegetables to sell in the morning and you sell them until you're done.
And that was the exact same thing. It was this cottage industry mentality of consultants effectively trying to get those mandates, but instead of getting the mandates in billable hours like you would do in management consultancy or strategy, you were selling the offsets as the bundle, right? Mm-hmm. And you're absolutely right. It does not scale because of its very nature. Sorry, I think there's a question. We can pull that up, and so let me kind of finish this thread. She
says later for the questions for later. So
but it's a perfect kind of tangent or thread that I'd like to pick up on. So essentially, to pick up from what you just said, Charles, I saw this opportunity that it was in front of me effectively and the team, that we could help to transform the market and to really help the market scale. Before it was in vogue, before there was a task force, et cetera, we saw an opportunity for exchange trading to become effectively the centralized marketplace. And CBL, we wanted it to become the centralized marketplace, but we also wanted to see other competitors come up, and I'll talk about that in a sec. But effectively, exchange trading provides the ability to simplify and to provide greater efficiency around how transactions are structured and cleared, importantly, right? So there's the security, there's the reduction in counterparty risk and in delivery risk, and most importantly, and now to Yufeng's question around transparency. An exchange provides inherently by its very nature prices on a screen. So there's a bid and an offer price, and then ultimately a transactional price, right? So a close or an assessed price or a transaction price. And there's a sticker, and it literally lit up green or red on a screen, and that's there for everybody to see. And so it represents the market value over time, maybe not on the one day, maybe there's some noise, maybe there's some volatility, but over time you see what the trends look like. In an opaque market, you don't get to see what price I structured that deal. So if I bought it at $2 and I sold it at $5, that's my arbitrage, right? And that's that classic sort of brokerage market where you're incentivized by opacity, right? But for a market to scale and to attract additional capital that then can be deployed upstream and to attract more and more corporate buyers that then feel comfortable in transacting in this market, because the very first question they ask is, how much of the money that I'm spending is being spent on fees? And there was this very nebulous kind of concept. Well, people would just pull out numbers without any validation. On an exchange, you know what the fees are, you know what the strike price is, you know what the market price was today and where it was a month ago, and now you can also develop other derivatives markets. So transparency is a core tenet. And so I saw that opportunity, but I said quite funnily, and I look back at this, it was very fortuitous. I don't know where I was crystal ball gazing, but it came back to my mind a couple of months ago. I said famously to Ben and Nathan, the two founders of CBL, I said, guys, I believe in this. I want to be part of this journey to help you build this solution. But I think honestly, we're 5 years ahead of where the market is at. And I said that in 2015. And so we fast forward to 2020, and that prophecy effectively came true. For about 4 years there, we're effectively just toiling away, building the technology platform and fighting the resistance essentially against the traditional intermediaries and brokers that were saying, hey, we don't want to give up transactions to the exchange. You'll ruin the party for us. And then really, leading up to COP, following on from COP in Paris, the seeds were starting to be planted, but leading up to the COP in Glasgow last year, when we got a resolution around Article 6, and before, we started seeing a ratcheting up in ambition around net zero. With the pandemic, I think it helped to accelerate that. And there was more and more companies making these commitments. And then because everybody was working from home and at home, technology took a much more dominant position in our daily lives. I mean, we're not meeting in Hong Kong in person. We're doing this over Zoom, right? And so from our end, I think we were, and it's obvious to kind of explain now, but we were beneficiaries of this shift towards online, towards technology. Traders and brokers were not meeting day to day at a pub or in business meetings. And over time, we started to effectively capture more of the market share, and essentially then transparency became more important. We started seeing more engagement from financial intermediaries, banks, hedge funds, financial institutions, funds who rely on pricing from an exchange in order to market their books. They have risk and compliance teams that cannot onboard every counterparty. So they don't want to take counterparty risk. They don't want to provide or transfer units without receiving funds. And so more and more as the market started to grow, and importantly, as prices started to go up, the notional value was also going up. So volume plus, multiplied by the price, the notional value of the deals were going up and up. And essentially what that created was this perfect recipe for exchange trading to really gain pace. So yesterday I hosted a webinar. I hope that you don't mind, but I figure I might just recycle a slide that I've got here.
Please.
And so let me do that. Can you guys see my screen?
Yep. Yeah.
Cool. So this kind of tells a story, hopefully, of what I'm trying to articulate, where essentially when we look at the notional value, which is these the white line, right, and the volumes, you can see that in 2019, the total volume traded on the exchange was somewhere in the order of 10 million tons. And then in 2020, that grew to 3 times that, to 30 million tons. So it's a pretty big year-on-year growth. And if I zoomed into this graph, it would look, like this kind of exponential growth. But when we factor in 2021, the year that the voluntary markets really gained pace, we saw that the volume transacted on CBL grew to 120 million tons. That's for 2021. In Q1 of 22, we've had, I think it was 47 million tons traded just in Q1. So we've seen that continuous growth. And in line with that growth in terms of liquidity profile, we've also seen a growth in terms of pricing. And as we've evolved and delivered new products to the market, which I'll come back to in a sec, we've started to see more and more interest coming in. That's effectively mopped up this kind of traditional oversupply. As the demand has been realized to be more significant, we saw this inversion of it. The market went from being purely a buyer's market, where the buyer dictated the terms, the buyer dictated the price, to effectively for the premium quality projects, and we'll get into that in a sec, how you define that, there was a flip, and effectively became a seller's market. And then we started to see the prices going up, and as a result, we started seeing notional value trend up really significant. And I want to just say and stress this: we're in the beginning of this process. Sure, we might see some pullbacks, we might see some dips, we might see, like I've got here on this next slide, increased volatility, right? So we've seen volatility spikes, but we're also seeing, importantly, reversion back to the mean. And I think importantly, we had this conversation yesterday with some market experts on the panel that I hosted, where we discussed the fact that in years and decades past, whenever financial markets caught cold, essentially, carbon markets got really, really hit hard. And this time around, it seems to be different. There seems to be a lot more resiliency. Yes, there was volatility spikes, and you can see where that occurred. Effectively, volatility started increasing right during or at the beginning of the war in the Ukraine, right? And the shocks that have happened to the supply chain and global commodities. But when we look at this volatility curve compared to natural gas, so Dutch TTF or nickel or some agricultural commodities, they pale in comparison, because the volatility spikes there have been much, much, much greater and much more sustained. Whereas here, they're acute, and effectively we've seen this reversion back to the mean. With regards to pricing, and what I'm showing here is a graph of not our spot pricing, but the futures prices, and I'll explain how those work. But effectively, CBL is a spot exchange, so it's akin to physical markets. So you buy something and you take physical delivery. In this case, it's a digital asset. The carbon offset is transferred from the seller's registry to the buyer's registry. In the futures, it builds on the physical market, but effectively it's a financial instrument. It's a derivative. It's what's known as a derivative. And these are financial contracts that are traded between typically large financial institutions, hedge funds, banks, commodity traders, et cetera. And it's only at the maturity of that contract, which happens on a monthly basis, that if you hold it through to maturity, there's an obligation to take the physical delivery. If you roll the contract or you don't like you sell it before maturity, you're just trading the financial instrument. You're not trading the physical. And as a result, there's a lot more liquidity in those markets. And so when we look at commodities like oil and gas and copper and, lithium, et cetera, the futures markets are, an order of magnitude, if not greater than the actual physical. We're only at the beginning of that process, but effectively we partnered with CME, the Chicago Mercantile Exchange, as they were formerly known, the CME Group, and they've developed futures contracts off our spot. So that's the context. What you're seeing here is 4 lines. The front month, the December 22, meaning that expiry is in December 22. The front month is, let's say we're in April, it expires tomorrow or today, right, at the end of the month. Then there's a December 23 and December 24. So these contracts mature at the end of the month. And so what we're seeing here is separation between the contracts. And you see these, what are called a spread between the contracts. The front month and the Dec 22 trace pretty closely. Basically, the market's saying here, well, buy it today or to buy it in December, it's pretty much the same price, right? There will be maybe some FX or some other exchange kind of like deviation, but it's fairly minimal. Where there is a separation is between the December 22 contract and December 23. One is the cost of capital to effectively carry the physical inventory, deploying the cash, and then agreeing to sell it at a future date. There's a cost of money. One, and then two, in these contracts, interestingly, there's a difference specifically in the vintages that are allowed and deliverable into these contracts. So the NGO stands for the nature-based global emissions offset contract, and it follows essentially forestry contracts under the VCS standard, and importantly, projects must have what's known as a CCB, or Climate, Community, and Biodiversity co-stamp or certification is more accurate. And if it meets those criteria and the vintage falls into the deliverable window into the contract, so December 22, for example, will allow 16s, 17s, 18s, and 19s and 20s. And then here it basically drops off the 16s and 17s. So there's a separation. The market's telling us here 16s and 17 vintage units are discounted by around a $3 or more spread, $3.80, I believe is the current spread, versus the 18s, and then here it's the 19s. So the market is effectively pricing at a premium the newer vintages. And so this is just the market's effectively evolving in front of us. But effectively this, I'm trying to get back to the theme here. So the price transparency is always visible on an exchange, and whether it's spot or futures, because you have the screen available, and that brings in an ecosystem of price reporting and price assessment agencies that come in and assess the pricing. That then builds, most importantly, confidence in the marketplace. Mm-hmm. And then that confidence builds liquidity, and we start seeing more and more participants. And it's this kind of what some folks call a flywheel effect. It starts gaining more and more momentum as it starts to build liquidity. Some call it a gravitational pull, whatever it is. But effectively, the more liquidity that tends to breed more and more liquidity. And that's what we're seeing right now at this point in time in the market. So I'll stop because I think I might have covered a bit too much.
No, that's good.
See if that makes sense. If you've got questions, and if the audience has got questions as well, happy to do a deeper dive.
Yeah, I mean, let's. I want to cover a couple of other things before that. First of all, what's your academic background? What was your what did you study, and how did you end up in this world at all?
Yeah. Okay. So really fortuitous. So at the point in time when I was studying and doing my university, there really weren't, and I grew up in Australia, there really weren't carbon or even ESG or climate, qualifications. So I found my way into this market by chance and curiosity. So to answer your question, so I did my undergraduate degree, I did a combined degree, Bachelor of Arts, Bachelor of Science. So basically and right brain. My arts degree, I focus on Spanish language and culture. It's my I was born in Colombia. I wanted to maintain Spanish language at a university level, reading proficiency, etc. So I did that for me and for my mum. Then the science I did really as a what I thought would be my career progression. I did a degree and focused on molecular biology and biochemistry. With a little bit of genomics and a little bit of pharmacology as minors, and essentially did an honors degree, had a pathway to become a PhD in that space. And I just remember being in a lab thinking, no, this ain't it. And effectively, I decided to deviate from that mission. But I was still very passionate about biotech and kind of this kind of commercialization. It was very de rigueur at the time, right? The human genome had just been mapped, and that was like, I was thinking, wow, it's going to be this big biotech revolution. How do I get into the business side? And so I thought at the time, very naively, well, there's this perfect kind of linkage between science and commercial, and the bridge is the intellectual property piece. That's where the scientific, like the companies, biotech companies, have their intrinsic value. I'll become a patent attorney. So then I did a master's degree in patent law. Quickly realized I didn't want to be a patent attorney. I'm a qualified trademarks attorney. I passed all the exams to get to that point, and then I was like, patent law, man, this is so boring.
Yeah,
but it was during that.
That's definitely a very boring area of the law. As a lawyer,
yeah,
even I know to stay away from that one, Rene.
yeah, and so hey, naivety of youth, and so I threw myself in the deep end. I passed a whole bunch of these patent exams, but I was like, oh, this ain't it. So I pivoted. I converted my master's degree into commercial law. And in that move, I did a subject on corporate governance. And in particular, as part of my thesis for that subject, I picked ESG. I picked in particular to write a paper on the role of the World Bank in pioneering carbon markets. And I basically just went down a rabbit hole. I submitted that, and it was the most enjoyable research that I'd done up until that point. And I thought, this is fascinating. And at the time I was, I needed to basically put myself through school. I had rent, I got to eat. And so I was, I was working in fashion industry, right? I was working as basically heading up a corporate division in a fashion company in Australia, of all things. And I was just like, this is not my career choice. So I started looking for work. And that's when I found this job opportunity. It was just like this perfect sign from the universe saying, yo, you need to apply here. And I did. And I came in really passionate, had sales experience, had obviously an underlying understanding of scientific and kind of some basis. And then they read my paper and said, yeah, cool, come and work for us. And that's how I started. So it was just very, very, very fortuitous, a very roundabout way. And I kind of found my way into this.
Well, I think it's a good lesson, and it's never too late to change your mind.
Never too late.
All you folks on the all you do in the middle of you doing your PhDs and your master's degrees, you can always shift gears and do something that you're truly passionate about.
And that's a reality. I learned this the hard way, but effectively, one of my mentors said, hey, you should stop focusing on what your title or what your job or whatever your parents want you to be. You should focus on what are the problems in this world that you want to solve. And when you get told that at 25 or 28, you're like, I don't know. And then lo and behold, I saw the problems that I wanted to solve. And I was like, hey, this climate situation is significant. Where can I apply my skill set? What can I focus on that can actually generate some traction? And I found my niche, and it was the voluntary markets. And it was a great group of people, really inclusive. And I just started contributing and learning along the way. And then I look back and people are like, considering me to moderate a panel or speak to students at a university. It's mind blowing, right? But
I'll send around that link to the panel discussion from yesterday. I think that people would like to hear it. It's a really good.
Yeah, sure. It was great, and we hope to kind of do more of those. I think now I realize that my role is twofold, right? It's to build capacity, because that's the only way that we can grow the overall pie, right? And so I've taken that really seriously. I worked extensively within the aviation sector to help that industry build capacity internally so that they can meet the decarbonization objectives. It's a passion of mine. My mum used to be a flight attendant. I love travel. I love airlines, and they're really cool clients. And so I've devoted the last 6 years to helping those folks. And we've got solutions in that space. We work with IATA, for example. We built the aviation carbon exchange. So that's a pet area of mine. But extrapolating that, it's also building capacity. So initiatives like this, talking to students, engaging with younger folks that are really passionate about this, and introducing them to our market, because we need effectively that energy that youth can bring into a market, right? What I've seen so far, and I know that it's coming for this market, is that the fight for talent will be significant, right? And so there's opportunities at every level in this space, from commodity trading houses to banks to funds to project developers to verifiers and validators to standards to exchanges to advocates, policy people, you name it. There are opportunities in this space because there's so much focus and interest coming into this area. So it's really, for us, it's a battle that we need to fight to engage young talent to come to this industry. The other part is to build the existing kind of talent pool and build the capacity. We can't dominate or own a specific part. We need to collaborate with one another because we're still in the early innings of this game, right? And now as markets evolve, there'll be natural competition and there'll be natural attrition and there'll be consolidation and all this stuff, right? But we're still very much in the early innings. And so knowledge transfer in that capacity building is really important. So going back to the webinar piece, we have identified that we play a unique role in this market as an exchange, and that we can effectively not only just match transactions as a matching engine, but also match participants and match thoughts and connect people. And so we want to provide that platform. So we're going to commit to continuing that webinar series, both online and hopefully in the next few months in person across different geographies to build out that kind of side. And then the other piece, let's say the day job, is to build the infrastructure that's necessary to help the market scale, right? So we need to build not only the technology solutions on the exchange side, which is our, let's say, lane, but also help to incentivize other really important parts of the ecosystem. So yesterday we had a great chat about how technology can disrupt this market and help the market to grow. Things like digital MRV, monitoring, reporting, and verification. How can artificial intelligence and other type of technologies help to scale the throughput of projects in the pipeline stage and through to accreditation and certification? How do we utilize those tools that can basically compute vast arrays of data, geospatial, satellite, et cetera, and then provide a really accurate view of the emission reductions on the ground? And that will then hopefully unlock the next wave of transactional volume and acquisition in this market, because corporates can then rely on the data, right? They can rely on the integrity of that. And then other things that are disruptive, like how do we encourage an ecosystem of ratings agencies and other types of disruptive tools like Web 3.0 type of solutions to help to aggregate demand from retail. And there's a whole bunch of other stuff. So we need to collaborate is what I'm saying. And we need to really push this thing forward.
Well, let's loop back to CBL. Tell us a little bit more about CBL and how big are you? What sort of people are you? Where are you all working? What are your big plans?
Sure. I probably can't talk about what are the big plans. No, only kidding. So who we are for context. I kind of glossed over a little bit of that, so apologies. So CBL today is the world's largest spot exchange for a broad array of ESG commodities. I'm talking about carbon because that's my day-to-day, right? So I lead the carbon team globally. It's fair to say that we represent, or our participants more accurately, represent the largest liquidity pool in the voluntary carbon markets as it relates to exchanges. To contextualize that, I showed you guys that graph. In 2021, we had 120 million tons traded on our platform. Our participants traded that volume. We provided the matching engine. Last year, Ecosystem Marketplace estimates that the total market size was 300 million. So by best estimates, we're somewhere in this sort of 40% of the total market volume transacted on CBL. So it's a pretty sizable part of the liquidity pool. There are other exchanges and they're emerging and they'll all compete and we as an industry will innovate as a result and compete to keep that market share or to gain market share against one another. But CBL right now is at the front of that pack. Our ambition is to remain at the front of that pack and to keep building those solutions. I mentioned the partnerships with CME. That was a really important step last year for us because effectively we went from this very illiquid marketplace early on in 2018 and before to start building that liquidity. And the majority of the transactions that I think still to this day have been on a project-specific basis. But we ushered in a paradigm shift last year where we introduced standardized instruments. So the first kind of step in commoditization, where effectively we create standardized contracts that allow for delivery of projects that meet a criteria set. That enables financial players to start to trade those and it builds a liquidity. CME took that spot contract, or those spot contracts more accurately, and built futures on the back of that. So we're in that second innings, let's just say. So CBL right now provides is what's called a transfer agent for CME. So when you take that futures contract that I explained to maturity, we match the shorts and the longs. We match the buyer and the sellers in that instance. And so CBL, we're building out this ecosystem to continue to build the liquidity. The way we also operate is we connect to registries. and that's a unique proposition that differentiates us from our competitors. CBL effectively owns that space. We own a company, our parent company, I should say, owns a company called EMA. It's a meta registry platform that integrates all the standalone registries into one location that allows our participants that hold the units in their registry account to post product into the exchange seamlessly. The transactions then move product from seller to buyer, and we handle the cash in the reverse from buyer to seller. All that's done in real time. Mm-hmm. And that differentiates us from our competitors that don't have that infrastructure. They instead will, like a casino, you go to the casino, you give them money, they give you a chip, and then you trade the chip. The units stay static until you redeem the chip. Mm-hmm. So these guys do that on a tokenized basis. A lot of corporates cannot do that because effectively their risk and compliance teams don't allow for that, because when you deposit units to someone else's registry account, you've transferred the legal title. So our model really allows for scale because it integrates with the existing risk and compliance metrics around businesses. So I'm giving a lot of color, but in essence, CBL is a centralized marketplace, the largest one around carbon. We also cover renewable energy markets, water, and a bunch of other kind of new digital assets that are emerging. So that's where we are today. We're also integrating and updating technologies to help this market to grow. I'll touch on some of those. So, for example, we're working with some ratings agencies to provide their ratings tools on our screen, on exchange, and in the registry environment. We also work with S&P Platts, which is the world's largest price reporting agency. They assess our contracts, and that influences, when they publish and distribute that, to establish our contracts really as the benchmarks in this industry. And so that's really where we are right now. In terms of the future, our parent company Expansive announced that we're acquiring APX. APX is the registry provider of choice in the carbon market. Essentially, they provide the registry services for Verra, which is the parent of the BCS, American Carbon Registry, ACR, and Climate Action Reserve, the CAR. That acquisition and that merger is essentially now with regulators, and once approved, then that'll provide another kind of integration piece into our model, and essentially it creates this end-to-end solution where we're at every touch point, at the registry, at the meta registry, at the exchange piece, and then most importantly at the data side. So we have a lot of banks, some funds that you're very familiar with, Charles, that subscribe to our data set in order to mark their books. And also, so they can provide their net asset value to their investors, and also then derive insights from the data to make and influence their trading strategies. So for us, it's this full vertical integration model that's ahead of us.
Gotcha. And a lot. One of the things which we're in the middle of right now, and we do have a couple of questions that are sort of more in the sort of technical side of what you talked about. But we're in the middle of talking about projects. And one of the things when we first met a year and a half ago, what was impressive about me was just how fluent you are in knowing, a fair bit about the 10,000 projects that are out there, or not 10,000, but probably a couple of thousand projects that are out there. What can you tell us about the sort of the reality of the projects and the constant sort of noise in the system about quality? My view is essentially, look, you got a registry that's got you basically have to swear that you're complying with all of the registry components. You got a VVB verification body that's out there going and auditing you every single year. You've got scrutiny of the local community that you're working in. You've got third-party rating agencies, looking and rating at your projects constantly. It's hard to imagine a more accountable system for such a diverse set of enterprises, but yet there is this continuing kind of quality or concern about, sort of fraud, which I don't think there's really been much influence or evidence of, or, at least exaggeration of benefits in the projects. What you know this industry well. You've been at this for 14 years. What's your view on this? And is this a drumbeat that's going to go away? And is it real, or is it just something that the media likes to grab onto?
It's the latter. It's that the media likes to grab a hold of it, and it's sensationalist, right? So that kind of sensationalist print sells, right? But you're absolutely correct. I think where we are right now in the juncture in the market is a lot of the groundwork has been laid already, right? For the last 2 decades, effectively, standards were developed in the voluntary market. Like you said, the full governance frameworks that underlie those standards were developed. They're based on the core tenets of voluntary carbon and all carbon markets, essentially, that project activity be real, that it be permanent, that it be verifiable, and that it has these checks and balances. And effectively, proponents can visit the projects. They can actually do their due diligence on the ground. There's a paper trail. And like you said, the verification and validation bodies are third-party verifiers. Their job is, and their credibility is based on their assessment of those projects. And if they stand by those assessments, the standards then review that documentation. If they have queries, they subject them to the projects. And only if the projects meet that high level can they issue those units. So you're absolutely right. There are many checks and balances that prevent against any false claims around the actual emission reductions of the offsets. So I think that in summary, the questions around quality are overblown when it comes to new issuances. Where I think a lot of the concern lies, and especially NGOs are very vocal about this, is the traditional, let's say, in the market, when we look back, historically, there was this oversupply and there was this overhang essentially of older credits, especially coming from projects that currently today are not additional. That's another core tenet of carbon projects. Essentially, there's an additionality test that needs to be passed, which is this: that the project must be essentially dependent on the carbon financing to be implemented. So that without the carbon financing dollars, that project activity just isn't financially viable, right? Mm-hmm. And that means that then the carbon finance brings those projects to life and gets them set up. I think those concerns are on logic insofar as there are projects that were additional 10 years ago that are no longer additional because market conditions have changed. So, and the standards have been ahead of this. So the best case in point really is, or are renewables, right? In particular, solar and wind. When we look at solar, there's it's kind of like Moore's law in semiconductors. It's called Swanson's law in photovoltaics, and essentially it shows that the price of photovoltaics is inversely proportional to the deployment, right? So the megawatt kilowatt hours, and essentially as more and more solar panels have been deployed and that technology has effectively scaled, the prices come down exponentially, right? And so for that industry, I remember really in 2008 and 9 and 10, there was this kind of big push to have solar, but it was not competitive with regards to baseload electricity generated by coal. So you needed carbon financing to get that off the ground. Today, it's different. Solar is probably the cheapest form of electricity. And so you can sell that at I don't know what it is now. It's like $2 a megawatt or something. And other fossil fuel-based energy generation is priced higher. So it's kind of perverse to have a carbon offset attributed to that project also when they can sell it at a lower price, right? So it's not really necessary. So those tweaks happen naturally in a market. And so there are concerns around sort of the kind of, digging from the crate effectively, kind of the older credits. But I think those concerns are really overblown because when we look at the actual issued volumes, there's not a whole bunch of those zombie credits as the media and some people like to claim, because just they're not there. They have been depleted in the market. So I don't think many corporates would even look at those from a risk perspective, even though they've been historically cheap. They're not that cheap in comparison, like the lower end of the spectrum. And they don't want to take that risk because it'll come back and bite them, right? And so I think, the focus on quality right now is focused on primarily, I would say, on nature-based solutions. That's where there's a huge proportion of supply that's imminent and it has been generated. And there's a really a focus on making sure that there's no double counting of those emission reductions between countries or jurisdictions where those projects are based and the corporate buyers. And so now we're figuring that process out. But quality is important. Ratings agencies put another layer, an impartial third-party layer to provide that quality stamp. And that's just the evolution of the market.
Got it. No, that's super helpful. Well, I don't want to run you too long, and we've got some good questions.
No, some good questions. Why don't we tackle some of the questions?
Yeah. I think you answered eFunds, but Jonathan was asking essentially about who's investing in futures contracts and why. We get the future idea, but why are people out there, thinking about it that way?
Great. That's a fantastic question. So the answer is a lot of different participants will trade in the futures. So if you're a hedge fund, you can hedge your risk by the futures, right? So you can go long, or you can go short, or you can short long, whatever. These guys are trading there in that space. If you're an airline and you're naturally short, essentially you need to meet a commitment. Let's say you're an airline with a carbon neutral commitment. You can hedge your price risk by effectively going long on the futures, meaning you can take that delivery in 2024, but you're basically paying the price today. If you think that the price is going up, that's a smart move, because effectively you've locked in the price today, and at the contract maturity, that's when you really need to true up effectively, right? And take the delivery.
So anybody who's got that who's made a pledge and who wants to lock in a price, who thinks the price is going to go up, they're all about that future contract. They're happy to get to it.
They should be. But in reality, they're not yet at that point. And yesterday's panel had a whole bunch of experts on it who were talking about, hey, and I'm looking for the quote because I thought it was brilliant. So Ariel Perez, who's one of the managing partners at Voluntary or Hartree Partners, a very, very large, essentially managing institutional money as a fund, said every corporate and institution around the world is short carbon. The question is, how much of that is compliance and how much is voluntary? From my perspective, 2021 was about cleaning up existing inventory, and 2022 is effectively the year that the realization by these corporates will effectively be deployed. I'm paraphrasing because it dropped off the quote from what I've got here, but essentially that's an opportunity that is yet undertapped and underrepresented. But to answer Jonathan's question, it's mostly commodity trading houses. So think a Trafigura, Mercurio, Vitol, a Glencore, right? These types of folks, and hedge funds and investment banks. So think of JP Morgan, investment banks like Macquarie that are more like infrastructure banks, but these have these carbon trading desks, and oil majors, right? Mm-hmm. Think of BP, Shell, Chevron, etc. They're actively trading in the futures. So these two markets, the physical and the spot markets, are aligned. So effectively, they could purchase right now in the physical market today, locking in a price, and then take the arbitrage by selling the futures contract, and they lock in their gain immediately there and then. Then they have to warehouse those credits and then deliver it at maturity, right? Because they're essentially short. And so these markets allow for this financial intermediaries to bridge. We're seeing more and more interest from other actors in the financial space, the retail banks that can aggregate volume from their corporate clients, which is a natural channel, right? If you're leasing or if you've got a loan with a bank, maybe you can also buy your carbon offsets from their book. So that's an undertapped and underrealized side. And then we're also seeing an emergence of essentially institutional, but also then public money. So emergence of ETFs and other specialized funds that are emerging. There's an opportunity for them to also engage in the markets, whether short or long. And so it is a way that effectively we can bridge the spot and physical markets to the financial markets.
Got it. So Eva's asking a little bit deeper on the standardized contracts, I think is what she's asking.
Yeah, great question.
Like what is the what is the underlying characteristics? We talk about the standardized contracts as kind of like a Kinder egg, where you don't know what's in them except a minimum set of standards to it. So talk a little bit about why you guys put them together that way and what those standards are.
Cool. Let me do that. I'm gonna bring up some slides, and then kind of, and I'm happy to distribute these to you guys, right? I've published these previously, and so folks can access it. So I'm just going here to kind of compare apples and oranges effectively. So I'm showing the breadth of the different contracts that we have. So I'll go through them really quickly, and then we can do a deeper dive, and I can show you the vintages and then kind of the detailed specs. But essentially, we have the Geo. That was the first contract that we published and launched in October of 2020. It effectively mirrored and mirrors still to date the CORSIA eligibility criteria. So for CORSIA, for the folks that aren't familiar, is a system that the aviation industry, as effectively governed by ICAO, the International Civil Aviation Organization, and essentially sets out this market-based mechanism where the aviation industry can collaboratively decarbonize. It's got four pillars for CORSIA, and it stands for Carbon Offsetting Reduction Scheme for International Aviation. Lots of acronyms. And effectively, the four pillars are as such. You have technological efficiency, operational efficiency, sustainable aviation fuels, and then carbon markets. The operational and technological efficiency, think of things like e-taxing, switching off engines, right? So you're not burning fuel on the ground, technology stuff, so the decreasing weight of the planes, having winglets, having better, so for the operational side, better radar management, a whole bunch of stuff, scheduling that reduces emissions and the burn of idle burning of fuels on the ground or taxiing around in the air. So those are just efficiency gains. They're no-brainers. The other and the silver bullet for the industry really is sustainable aviation fuels. Can the industry invest to develop fuels because they need that high calorific value of fuel and the high energy density to be able to generate, lift off the ground, right? There's no really equivalent for electric planes for passengers right now. You need hydrocarbons. And so they're saying, well, okay, we need hydrocarbons, but if we keep extracting them from the ground, we're just burning and creating net emissions. Can we sequester emissions and then effectively burn that biofuel, and therefore it's a net zero, right? And so that is currently being deployed, and it hasn't yet achieved scale. The current sustainable aviation fuel, or SAF, is sometimes I think the best estimates like 2 to 3 times more expensive than jet. That may have narrowed now that oil prices are slightly higher, but it's still a pain point for airlines. So they can't go long because there's just not enough supply. So that leaves the fourth pillar, the market-based mechanism piece for them to access. And that's effectively airlines can buy offsets. So that's a long background. And again, I spend a lot of time in that space. So we developed this contract to effectively mirror those criteria. So what we've got is 3 registries, VCS, CAR, ACR, the vintages, 2016 to 2020. There's a project start date requirement of 2016. And these mirror the rules that were devised by ICAO. Right. And so this basically became the benchmark and has become the bench for CORSIA eligible units and units that meet this criteria deliverable. The next cab off the rank was this NGO, which I mentioned earlier. It's a nature-based contract. It focuses on single registry, VCS plus the CCB accreditation. It has a vintage window that I'll show in a second, but it'll in July of this year expands to include 16 to 22, and then we roll, and I'll explain how that works in the next slide. But effectively, it's a benchmark for AFLU, so afforestation, forestry, and other land use, forestry in market speak, basically forestry credits. There was a need for a trailing contract, so a contract that trails the front contract, so older vintages, but it's the same like basically premise. And then here, what we're calling the core geo contract, essentially excluding AFLU, but just it's a renewables contract. Think of it that way. We've effectively mirrored what the geo is, but we've dropped out the vintage start date. So it's a far more liquid pool of offsets. So you effectively get nature-based and tech-based. That's our kind of jam, right? So here I'm going to summarize what they look like effectively in that spectrum. So you have on the technology side, you have geo, the CGO, and then the trailing contract. And on nature-based, you have the NGO and the NGO trailing. That leaves a space here for a removals contract. And the reason why I've got it like this is that these are the benchmarks, and these are premium basis contracts, and these are discount basis. So these contracts, in theory and in practice also, trade at a premium to the benchmark. Conversely, these ones that are trailing, i.e. the older vintages, trade at a discount. So this hopefully answers the question around why we developed the standardized instruments. It's one, to make it effectively, like you said, a generic basket approach. It builds the liquidity much more significantly because it removes the kind of the friction of like, no, I've got a project in Pakistan, I've got one in India, I've got one in China. And like all of the variables are taken out. The project meets a criteria. I'm selling an NGO or I'm buying an NGO, right? It really simplifies the transactions, and it allows for now people to price their credits at a premium or at a discount because there are different baskets to choose from. So that's the kind of the standardized instrument complex. We've also got some slight nuance in terms of where the vintage eligibility goes, and this is us building the plane whilst flying it. But effectively, in the future, excuse the pun, there'll be this alignment around what are the eligible vintages for across all, and they're all harmonized, either rolling or not rolling. But we publish this, and now the market has this. All traders will have this kind of graph or chart on their trading desk, and they know what's deliverable and what's not. And that, going back to that chart that I showed earlier, that's why we see price disparity. So, for example, in July 24, we roll. And effectively, this is why there's a 2019 vintage only eligible. And that's why that December contract, where most of the open interest is, has a price premium to the December 23 and then for December 22. right? And so this helps the market to build. Now, the idea here is that you have liquidity building on these contracts, and it'll continue to build, because as the years roll on, that means new projects are deliverable. That means also older vintages fall out. And so there's this natural attrition that will occur as these contracts mature. It allows folks to go out there and finance projects and effectively be able to know or have a really good estimate around what the market value will be when those projects come through to issuance. And they might even be able to structure deals on a forward basis using these forward curves, or they might even be able to hedge by selling that futures contract. And so we're leveraging financial markets to effectively build the ecosystem. That's the short of it.
So buyers typically, the aviation buyers are looking at the geo contract typically,
Yep.
and
I think that's fair to say. Yep.
And because it's built around there, but the other ones are sort of different categorizations. And when somebody comes to the table and buys this, a geo or an NGO or one of the trailing contracts, they can basically crack it open and have, oh, well, look, that's a Indian wind project, or that's an Indonesian forestry project, and they at some point they'll know what they get, and then they can retire it and they can claim credit for it. So
that's a really important point. Sorry, I didn't mention that. I should have glossed over it. Even though it is let's say a basket, upon settlement on CBL, which is that same day. So when you execute a trade and you buy 1,000 tons of geo, you get delivered underlying units. So exactly right. You'll get delivered project VCS 1867. It's geo eligible and it's a China wind project. Tomorrow you trade it and you'll get delivered a different project. It's an India solar project, whatever it might be, but you get those underlying units. So now you basically put your hand into a mixed bag. You're coming up with a bunch of lollies and you go, oh, I really like this one, this one, this one. Don't like this one. And you can sell it. That boosts the liquidity, right?
Yeah.
And so that's the idea. Essentially, commodity traders can then start rotating their portfolios accordingly, and that builds the liquidity of the market, as opposed to having to wait for a corporate to make a decision in 45, 60, or 90 days, where they will then pay for your credits at the price they locked in 90 days. And you're just sitting there as a project developer going, when am I getting paid? I've got bills to pay. I've got people to pay. I've got to pay verified. It's like, and you're at the mercy of a corporate. In this case, a financier can come in and go, great, that project is eligible for this contract. The market price is 11. I'll offer you 11.20. Are you good with that? Or I'll offer you 10.80, right? Deviating from the benchmark. And then but the money's on the table. Yeah. And that project developer can say, great, you take it. Now you take the risk and you can take the reward as well. And then the corporate can come in and then they can face what's known as a high quality or A-rated balance sheet in facing a fund or a bank. And they can transact with those guys on whatever terms. And the banks will price in those terms accordingly. The risk of the counterparty, their rating, and their creditworthiness, et cetera. So it's just leveraging financial markets.
So can you explain a little bit, since we're really in the middle of, so we're looking at these different types of projects and the different kind of criteria. So you've got some baseline contracts, essentially these standardized contracts that essentially get buyers to a minimum set of standards, vintage and quality, et cetera. Why are buyers going beyond that minimum? Why do they want something more than that? What are they willing to pay for premium projects, and why are they willing to do that?
Great question. So the answer is, it depends on the corporate, but the rule of thumb, the more visible you are. So if you're a B2C corporate, right? So you've got customers that are people, right, in the real world, in a brand. Let's say you're an ad, right? Let's say you're a fast-moving consumer goods company, right? Like you're a Nestle or you're a telephone company or a car company. You have people buying your products, and so brand is really important to you, right? And there's a whole intrinsic value of your brand, right? And my trademark attorney hat. So brand and reputation is really, really important. So why would you want to pay for something that's higher quality and be willing to pay a premium above the benchmark? Because you're going to talk about it. You're going to say, typically, we've made a net zero commitment. We're sincere about addressing our carbon emissions and a bunch of other ESG sort of attributes. And we're serious about decarbonizing our supply chain, et cetera. Here's how we're doing it. And they would talk about all the internal emission abatements and reductions that they can do. And for the emissions that they cannot reduce internally, they'll purchase offsets. And so they'll want to showcase the offset projects that they purchase. for an airline, I'll give you an example. Some of the kind of drivers, and we work very closely with a number of airlines through the Aviation Carbon Exchange, but also we've had long-term clients like Delta Airlines, and I don't think that they'll be frustrated with me talking about them as an example. But the key driver is, airlines service communities. They service people in those communities. And so when you're an airline, you fly to different places in the world. They call them routes or routes. They fly to those different routes. If they're opening up a new route, like Delta opened up a route to Guatemala, I had the fortune of going with them to visit a project that they had effectively contributed towards the financing of by purchasing offsets from those projects, and they got to go into those communities, talk to the indigenous communities that the project helps and are benefiting from that financing. They want to have that touch and feel with the projects, and then they can communicate that to their clients. That resonates with their audience, and that helps to build more brand equity, right? So that you want that from a visibility. Now, if you're a mining company or you're someone else in the supply chain and you're just B2B, maybe your clients don't necessarily care. So maybe you're buying, your biggest driver is essentially lowest cost. And so those folks can actually access the contracts. But the contract provides basically the benchmark, the baseline onto which everything's traded. And you now then have an understanding of where that price is today, whether it's up or down, and you can make qualitative decisions based on quality. So qualitative decisions on whether you pay a premium or a discount.
Gotcha. No, it's super helpful.
Yeah.
Well, I think we've got time for sort of one more question. I think
Sure.
Young Yi has got it here, which is essentially, there's some skepticism about the carbon finance and its role in dealing with climate change. How would you respond to that? How would you sort of say, no, this is really the way to go? What are the 2 to 3 reasons why the carbon markets and carbon finance really can drive change, in the trajectory that we have currently on on climate change?
Well, yeah, but I have a vested interest, right? So to take it with a grain of salt. But I hope that other smarter people than I, so I point to the Task Force on Scaling Voluntary Carbon Markets, which is now the Integrity Council and BCM. There's a whole bunch of acronyms in our industry, but essentially, smart folks from a wide-ranging parts of society and private sector who effectively gathered to address the question that you asked earlier around quality, but really to address the key component, which is the complementary role, and in this case for nature, because I think there's a shift towards nature-based emissions, so I'll highlight that. The complementary role for nature to really reduce and increasingly remove emissions above and beyond what would otherwise be possible. And that's where the climate financing comes in. Climate financing enables that, and then it builds, importantly, climate-resistant or resilient, I think is the word I'm looking for, development, right? And that's really important within the context of maintaining a global increase in temperatures below the 1.5 degrees C. So if you have this concentration of capital in the developed world, but you're not deploying it in the developing world, then you're just leaving the door open for the developing world to follow the mistakes of the developed world and effectively invest heavily into fossil fuels. There's an opportunity to invest into renewables and into emission reduction technologies and into nature, protecting natural ecosystems. And so as finance starts going into that, we're effectively valuing those attributes and promoting resilient development. That's really important so that effectively developed world and companies can effectively mitigate their carbon emissions and create benefit on the other side. I guess the skepticism that occurs is driven in large part by sometimes nefarious actors. There's no question about that, right? Unless there's validation, certification, the full process and governance around it, then there is an opportunity for let's say, cowboys to kind of come in and do some stuff that's unregulated. But also, so there are those safety checks and balances. But so that skepticism comes in from media stories and some NGOs that have an axe to grind, to use a poor metaphor. Yeah. But effectively, it's our role as an industry and to effectively not enable that, to maintain and ensure the integrity so that there is a clear proof and provenance of where the money's going, what impacts they're generating, and then that the claims can then be substantiated. And the financial instrument, right, which is essentially what this is the tradable thing, right? Like what you're trading. The offset is this legal title piece, but it's the ability to claim reductions against your footprint. That's the really important attribute to the corporate buyers.
Gotcha. No, that's awesome. I'm conscious of time. We've run way over what I asked you for, and I really appreciate it, Rene. Every time I talk to you, I learn so much, and I know that the students did tonight too. So super appreciated. And
my pleasure.
I'll circulate the webinar from yesterday, which I think is sort of the best up to date view on the carbon market from a variety of perspectives. So,
well, thanks. I appreciate that. The dialogue was great. I will admit that, but we did have some technical issues. So in the webinar, unfortunately, the videos weren't captured on GoToMeeting, and we did have some panelists with some tech issues. So apologies in advance for that. But hopefully, once you skip by the first in a minute or so, you kind of forget that. And then listen to the dialogue. There's an interesting kind of moment of inflection really in this industry. A lot of interest, and like I said from the outset, Charles, I'm very keen to help support the knowledge transfer piece. So if you ever want me back, or if your students didn't mind me droning on, happy to help any point in time.
Oh, thank you very much. Well, I'm sure they'll know how to get a hold of you.
Well, I'll send you my contact details, and then feel free to distribute to the class. And
thanks.
Always happy. Look out for me on LinkedIn. Send me a message and a connection if you want. I'm always publishing stuff, and always happy to hear from folks. Again, as I said, you guys are at the beginning of your kind of career trajectory. There's going to be opportunities in our industry, whether it's with us or with competitors or with other folks in this industry. So let me know. I'm happy to connect you with folks wherever the interest lies.
Yeah, thank you, Rene. Really awesome to talk tonight, and I will we'll sign off now and let you go, and we'll take a break. The class will take about a 10-minute break. Come back at 8:25. But thanks, Rene. Take care.
Pleasure, guys. Enjoy. Thanks for the time, Charles. Really appreciate it.
You bet.